One of the myths associated with incorporation is that people believe they can deduct more expenses if they incorporate. That's simply not true. There are two general rules when it comes to deducting expenses for tax purposes, and those rules are the same regardless if the individual is self-employed and wants to deduct the expenses in their personal tax return versus if the individual has incorporated their practice and wants to deduct those expenses in their corporate return. The first rule is that the expense must be incurred for the purposes of gaining or producing income. This means there must be some sort of correlation between actually incurring the expense and the ability to generate more income or any income as a result of incurring that expense. The second rule is that the expense must be reasonable. So the example that I often give is that you can't pay a family member $100,000 a year for coming into your office or clinic or your practice and doing filing or cleaning once a week. I do get some questions on certain expenses, specific expenses, like dry cleaning, buying scrubs, buying certain types of medical or dental devices, such as I recently had a surgeon ask me if they deduct these special glasses that they had to get while they performed surgery, and also general meals while at work, which I talked about before. All of those are actually considered to be not deductible.